The major averages in the green today, trying to finish that way. The S&P, the NASDAQ closing in on record highs yet again. Our next guest says the return of animal spirits sets the stage for even more upside in the months ahead. Let's bring in Ed Yardeni, President, Yardeni Research. Good to see you. Welcome.
Thank you, Scott.
So you think the goalposts really have moved, huh?
I do. I think that, John Maynard Keynes came up with the expression animal spirits, and the idea is spontaneous optimism. And we did see that in 2016 when Trump was elected and Trump 1.0. I think we're seeing again in Trump 2.0. I think the markets are excited about tax cuts for corporations as well as for lower income Americans. So that'll help the consumer sector. I think there's excitement about deregulation. And I think there's even expectation that some of these geopolitical crises might end sooner rather than later with Trump's diplomatic intervention. So you put that all together and you get a very upbeat scenario. But I was pretty upbeat about things before Trump was elected, because I think we're also seeing a significant rebound in productivity growth. And that's really driving the economy to a large extent over the rest of the decade.
I feel like before, on the euphoria scale, if you will, you were almost at a 9, like feeling like it was getting a little bit out of hand. So has the prospects of what this new administration could bring brought that meter down at this point? Because it certainly feels post-election like it's a bit euphoric. And I'm not the one who's used that word. Others have, including Nelson Peltz today.
Yeah, I've talked about the possibility of a melt-up scenario. I mean, I keep talking about the roaring 2020s, but I give that a 55% probability. I would say 25% to a melt-up. Too much of a good thing. I think the Fed's making a mistake here, lowering interest rates and stimulating an economy that's already doing quite well. And that could very well spill over into the stock market and create a melt-up. I mean, look, valuation multiples, everybody agrees, are stretched. However, we've had this terrible recession for the past 3 years that just didn't happen. The most widely anticipated recession of all times didn't happen. It was reasonable to think it might, with the Fed raising interest rates the way they did. But if we didn't have a recession the past 3 years, why should we have one over the rest of the decade? And the longer out you can see the economy growing, the higher valuations people are willing to pay. So that's what we're in right now. But yeah, I wouldn't dismiss the possibility of a melt-up scenario.
I mean, if you're raising your estimates for earnings for both next year and the year after, are you raising the multiple on the market as well, the price we're willing to pay for those earnings?
Yeah. Look, Scott, I've been bullish, but not bullish enough. When the market bottomed in October of 2022, it took us a couple of weeks, but we thought that was the bottom. And a lot of people said that can't be the bottom because the forward PE is 15, and that's ridiculously high for a bottom. But it turned out that was a bottom. And at that time, I thought, well, maybe we could get up to 20, and people thought that was delusional, and I wasn't delusional enough. It got up to 21, and now we're at 22. So, yeah, I did raise it. I think that these valuation multiples can be sustained for a while, as long as there's no recession that suddenly brings them down.
Going to get a rate cut in December, you think?
I don't know, Scott. I didn't think that they should have done 50 basis points. 25 was enough for me back in September 18th, and I thought it would be none and done after that, but they just won't listen to me. They got their own opinion, and the reality is they did cut by a quarter, and looks like they still want to cut by another quarter, but the data just doesn't support that at all. And by the way, the bond market begs to defer, because we've seen the bond yield go up by 75 basis points as they've cut the Fed funds rate by 75 basis points. So my friends, the bond vigilantes, are trying to send a signal, no mas, we don't really need the Fed to cut rates.
Yeah, it's tricky because some would say, well, the CPI today suggests that it keeps the door perfectly open for them to do that. And if they do one more and then wait, so be it, right? I mean, what's the big deal if they do another one?
Yeah. Well, look, it depends, what you're looking for in the CPI. You could find trouble there. And, I I've been a disinflationist. I've been arguing we'd get down to 2%. But on the other hand, the super core inflation, the services, the core services, excluding energy and excluding housing, that's turned out to be kind of sticky in the CPI, right around 4.6%. And Powell is the one who came up with that concept, and now it's suddenly not very important. But Scott, to your point, it's not a big deal if they do 25 basis points in December. Just, I would like a nice leisurely bull market for the rest of the decade. Just because I do doesn't mean it's going to happen, and it could be a melt up, and the Fed could fuel a melt up. Look, what the bond vigilantes are saying is that we've got stimulative fiscal policy still. It might be more stimulative, and we don't need the Fed to create monetary stimulus, because then the risk becomes 2021 all over again. That the Fed's fighting, trying to keep unemployment down, and all of a sudden they get this huge inflation problem, as they did in 2022, 2023.
You do have a 10,000 target for the S&P by the end of the decade. So
Yep.
Here's to your bull market prediction. Ed, we'll talk to you soon.